Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
During this episode of the 15-Minute Financial Feast podcast, we're listening in on Troy Westendorf and Mark Triplett's Lunch and Learn series, where they covered a wide variety of retirement and tax planning strategies to help you retire with purpose on time. Hey everyone, welcome to our Lunch and Learn session. This is Troy and I. We're attempting to spend about 15 minutes with you just to talk about a very specific topic, try to bring some value to you over the lunch hour, a little food for thought, a little bread for the head here. And each week we'll come with a new topic and spend about 15 minutes really drilling down on something very specific. If you have follow-up questions, you're more than welcome to reach out to us and talk about any of these. Today's topic is all about whether or not you should pay income tax now or pay income tax later on in retirement. And is it a good idea to take advantage of some of the tax rates that we have today? Particularly, we're going to talk about why being too tax efficient in early retirement or now can actually come back to haunt you, and two smart end of year moves that you might want to consider making before December 31st of 2020. And last but not least, why and how the Secure Act of 2019 and the Tax Cuts and Jobs Act of 2017 have really changed the landscape on how to plan for the distribution of your taxable accounts.
So Mark, you kind of hit on it, but that first question is, can you be too tax efficient in your retirement years?
Well, funny you should ask, Troy. This actually happens quite often where we see folks who have been encouraged either by some of their financial professional or perhaps even their tax historian, not their tax planner, but their tax historian who does their taxes is telling them to keep kicking the can down the road and tax defer. And sometimes folks will be so tax efficient early on in retirement, they'll spend all of their after-tax dollars. They'll spend even Roth money, never taxed money, early on in retirement, thinking they're super tax efficient, only later to get into a position where all they have left is pre-tax money. And either by choice or by force, they have to distribute those pre-tax dollars and at ever increasing quantities because their inflation adjusted spending is higher, or once you reach 72 under the Secure Act, it changed the requirement of a distribution age to 72. Once you're forced to start making those distributions, you can imagine you get into your late 70s, early 80s, larger quantities of pre-tax money are dumped on top of your income, and that affects Social Security taxation. That can affect Medicare premiums. So all kinds of problems that can occur if you get, we call it tax equilibrium. Imagine a scale, and you get out of balance because you spend so much effort early on trying to be tax efficient, only to come back to haunt you later.
Right, you say 72, and 72 is still pretty much your active years. I mean, it's not like your spending goes down at 72.
No,
you're still doing things at 72.
Absolutely. So Troy, I got a question for you. What two smart moves could folks consider doing right now before year end to put them in maybe a better position?
Okay, so, and we're doing this now. We are getting, and some of the folks on here may know, but we're getting the incomes from those that we think could qualify for some Roth distributions or for Roth conversions. What we do is we make sure we get them incomes correctly for the year. We want to get it as accurate as possible. And then sometimes, maybe they need to make a large purchase at the end of the year. Maybe there's something they've been wanting to do or taking dollars out for. Maybe it makes sense to take it out of and pay at the lower tax rate if they have brackets to fill up that lowest marginal tax bracket. The other thing we're doing is obviously Roth conversions. If someone can pay, at the 12%, 22%, we're looking at that and trying to fill up those tax brackets because we know we're getting to pay taxes at a discount. And I told you earlier, I had my aunt yesterday. She asked me about gifting. Does it make sense to gift? Should I fill up my tax bracket? She had a 12% bracket. Should I fill that up, gift these dollars to my children, and pay that tax at a low rate rather than giving them the burden of paying tax at the higher rate during their working years? So that was one of the things we did yesterday, and it just came up. It's like, yeah, that does make sense.
Sure.
Let's fill in that bracket, gift the dollars you want to give to your kids, You can allow them, she wanted to see them spend it now rather than later when she's not around to watch them do it. And she's going to pay at a low tax rate.
Well, I think we tend to forget that these opportunities are on a 12-month cycle.
Yeah.
Once December 31st rolls around, any opportunity to take advantage of filling up those tax brackets for 2020 is gone.
It's over.
You can always go back after the end of the year. You can go back sometime between January 1st of 2021 and when you file your taxes and contribute to an IRA or a Roth IRA or something like that. But you can't go back and do a conversion.
Right.
Or you can't go back and say, hey, wait, I had some capacity in the 12% bracket. I really wanted to buy a new car. It's going to cost $30,000. I'd like to take $15,000 distribution for 2020 in the 12% bracket and take the other portion after the first of the year. You've got to plan that out ahead of time before that clock before that clock strikes midnight on December 31st. Exactly. So that's good. That's good to think through for sure.
Perfect. Well, let's see what we got for another question here. You talked a little bit about the Secure Act, Mark. 2019 Tax Cut and Job Acts. How does that change? I mean, what's changed? Why are we, this whole year, it seemed like with the market downturn, we've been after clients. Hey, if there's a chance to do a Roth conversion, let's do it. Some of the things we've just talked about, why are we looking at a window, I guess, of opportunity right now? Sure.
Well, let's start with the Tax Cuts and Jobs Act first. Out of these two tax law changes, the Tax Cuts and Jobs Act was passed in 2017, took effect in 2018. And for many of the folks we work with, it reduced their tax rates and widened the tax brackets. I'm a visual person, so it's much easier for me to get my arms around this when I can see it. So I'll share a little visual aid with everybody here. I think it's here at the end. We're going to jump forward. Yeah. So this is just a graph that I put together for my own personal benefit to really help understand where were tax rates in 2017 relative to where they are now. And are there any sweet spots where I'm getting a serious advantage of doing any type of distribution or conversion in that area? So for example, if you look at, in particular, the 24% bracket, and the 22% bracket. So in the high end of the 22% bracket under the Tax Cuts and Jobs Act, that would have fallen under a 28% tax regime prior to the Tax Cuts and Jobs Act. Okay. Now, what some folks know and some folks don't is that if no action is taken by Congress, these Tax Cuts and Jobs Acts will sunset in 2025. So in beginning of 2026, we're scheduled to revert back to the 2017 tax bracket structure. So if you're in that position to do some Roth conversions now, or you're thinking about making a large purchase and you have capacity in some of those 12, 22, or even the 24% bracket, it's a really good time to consider doing so. Now, the Secure Act of 2019 really impacted inheritance and leaving pre-tax money to beneficiaries. And this is why we're doing a lot of proactive planning with clients. When we've done a full workup on their retirement plan, we've identified what they're going to need to maintain their lifestyle, where their income sources are, what assets they're going to have to distribute over time, and how do we all plan for that. Generally, there's dollars left over. Right. Yeah, there are dollars that they're probably not going to use in their lifetime, and that may end up going to their kids. And if you just leave pre-tax money, I'm talking about IRA dollars, for example, you leave that pre-tax money to your kids. In the past, they could stretch those distributions out over their lifetime and really manage the tax rates. With the Secure Act passage, it eliminated what we know as the stretch IRA. Right. Now, when a non-spouse beneficiary inherits pre-tax money, IRA money, for example, a non-spouse beneficiary is required to liquidate the account by the end of the 10th year. And there's no set pattern at which that has to happen. There's no longer a requirement of distribution on any, and this affects people that inherit money after January 1st, 2020. Okay. If you inherited an IRA prior to January 1st, 2020, you could still do the stretch. That's okay. That's grandfathered in. But anybody that inherits money now, they have to liquidate that account within a 10-year period of time. And if you don't take any money out in the first year, that's okay. You don't have to. The second year, don't have to. Third year, don't have to. But if you don't take anything out and then you wind up in the 10th year, you have to distribute all of that pre-tax money you inherited from, say, your mom or dad in your prime working years. Remember, these folks, by the time they inherit this, are probably in their prime working years with the highest income they're ever going to have. And that can dump a lot of pre-tax money on top of them. If they're planning for college, it can affect college aid, financial aid for their kids, all kinds of problems. So what we're trying to be proactive with some of our clients is identify some of those pre-tax dollars they're probably never going to use and helping them start to make good decisions about maybe filling up some of those tax brackets, paying that tax now in a 12 or 22 or even 24% tax bracket, leaving Roth IRA money to their kids. Still has to come out over a 10-year period. A Roth IRA still has to be distributed over 10 years, but it's all tax-free to the beneficiaries as opposed to being taxable. So just being smart about how and when we pay taxes. And we want to take advantage of the Tax Cuts and Jobs Act while we still have it.
Right.
And be mindful of the changes in the Secure Act that make it less advantageous to leave large sums of pre-tax money behind.
And you say as long as we have it, what is the time frame we're looking at having this window of opportunity?
Sure. So through 2025. So we have 2021, 2022, 2023, 2024, 2025. It's 5 years plus 1 month. Right? We still have the end of the year in 2020 to make choices for this year. But then after that, we're down to 5 years and so on and so forth.
And that's a good point because he says he passed it on to your heirs because I had a client yesterday and that's the whole, the not converting it wasn't going to hurt them at all. I mean, they're still going to be fine. It's their kids that were going to be inheriting all these IRA dollars at some point that was going to do some damage to them more so than the client. So that's a good point. So you talked a little bit when we started this, how this whole equation of math is like a fourth grade math, which is perfect for me because I was like seventh grade. so tell us how simple this equation is to do the math on this so they can figure this out.
So whether or not you should consider either making large purchase decisions now with pre-tax money or doing Roth conversions and filling up that tax bracket is really going to come down to two simple questions to ask and answer. So do you think that tax rates will go up in the future? And number two, do you think that you might be in a higher tax bracket in the future? Okay, so now looking at the Tax Cuts and Jobs Act versus the way taxes were in the past, do we think that either one of those is going to occur? There's a likelihood for many people that the answer is going to be yes to at least one of those questions. Okay, so if that's the case, then we need to determine, well, does it make sense to do the conversion now or wait? Okay, and it's really simple math. I've heard all sorts of confusing opinions on whether you should pay taxes now or pay taxes later, but it really comes down to, are you going to be in higher tax rates later on, or are you going to be in a higher tax bracket later on? And I'll prove it with simple math. Okay, so all you really need to do is, first of all, understand the rule of 72. Okay. So the rule of 72 states that if you take the compounded rate of return, divide it into 72, you'll know exactly how many years it takes your money to double, or vice versa. You can take the number of years for your money to double and divide it into 72, and it'll tell you what kind of compounded rate of return you have to get. Okay, so at 7.2% compounded interest, okay, your money doubles every 10 years. Just so we're square on that. I'm not making this stuff up. That's how the math plays out. Okay, so if my money is going to double in 10 years and I start with a pre-tax IRA of $100,000, okay, and I decide that today I'm going to convert that $100,000, and we'll assume that I've got a 22% federal tax rate and a 5% state tax rate. So I'm going to pay 27% in taxes, right? So $27,000 I've got to carve off of that. Okay, so how much do I have left? In that case, I'm sitting with $73,000. Now, if I invest that $73,000 and over 10 years, I earn 7.2%. I'm not saying that's what you're going to earn or anything. I'm not making promises here. That's just the math. We know that over 10 years, that would double. So 73,000 in this case becomes 146,000. Okay, so it doubles over that period of time. All right. Now, one of the arguments that I hear often is that, well, if I do the conversion, now I have less money working for me, right? Yeah. I don't have $100,000 working for me. I did the conversion. I only have 73,000 I'm investing, and that doubles over 10 years to 146,000. But I lost out on that opportunity to have that other money working for me because I paid taxes on it. Let's go through that math here real quick. So if I start with 100,000 and I don't do the conversion, okay, and I double that money over 10 years. So my IRA, for example, pre-tax IRA, starts with 100,000 at 7.2%, same interest rate.
Yep.
It doubles in 10 years to 200,000. That seems like a better idea, right?
Yeah. I
I have more money until you go to pay taxes on it. So if I assume the same federal tax rate of 22%, I assume the same state tax rate of 5%, it's 27 total, so 22 plus 5 is 27. I end up with the exact same amount. The end result is the same.
The same amount.
Correct. So all you really need to do is ask yourself, am I highly likely to be in a lower tax rate in the future or a lower tax bracket? Or am I highly likely to end up in a higher tax rate or a higher tax bracket? That should be the real defining decision-making question to answer as to whether or not you should make large purchases and fill up some of those tax brackets, or perhaps maybe do some Roth conversions this year. So it's real simple math to make that decision. And I can't stress it enough. You look at the benefits of pre-tax money versus Roth money, or even after-tax money. If I do that conversion and it grows from 73,000 to 146,000 in 10 years, versus having my pre-tax money grow to 200,000 and then pay the taxes on it, then one account is never taxed money, the Roth IRA.
Yep.
The other account is after-tax money. Now, after-tax money, it's like the money sitting in your savings account or after-tax brokerage account. What happens when you earn interest on those dollars? You have to pay taxes on the interest, right? Well, what happens if you invest it and you get a capital gain? You have to pay capital gains tax on those dollars when you realize the capital gains. What happens to the money in the Roth? If I earn interest, no tax. If I earn a capital gains, no tax. If I leave it to my beneficiaries, no tax. So even if the tax rates were the exact same today as in the future, you still might be better off doing a conversion now versus waiting. So that's why we're so proactive with our clients and everybody, just to let them know, look, this is a real good opportunity right now. Taxes are effectively on sale. Mm-hmm. Don't miss out on this opportunity. So we're closing up here on the 15 minutes. We're going to wrap things up. I will thank everybody for joining us today. If you have questions about the topics here that we have discussed, you can schedule a call. On your screen, there's a button you can click and schedule a 15-minute visit to talk about something that's important to you, whether it's this topic today or something else that's on your mind. You can also register for our next event by clicking this button here. Next week, we're going to talk about IRMA.
Nice. I like
Who's IRMA? Well, IRMA is the income-related monthly adjustment amount for Medicare. It's a Medicare surcharge. And it impacts the wealthy. So
basically nobody knows IRMA.
Most folks don't understand IRMA and how to avoid having that surcharge apply. Right. So we're going to talk about how to take measures now to avoid being in a situation where you're impacted by the income-related monthly adjustment amount on Medicare, that surcharge on the wealthy. So we hope you can join us next week. And last but not least, I'll leave you with this. If you haven't visited our new website for our new website called mypt5.com. mypt5, mypt5.com. This is a great place to learn a little bit more about our philosophy, to learn a little bit more about our process. And if you are going to introduce anybody to us, please send them here to this website first. They can check us out from the comfort of their own home. If they do decide to engage with us, let them know that one of our valued clients has introduced us to them, because we will waive our planning fee. We charge $2,400 for that initial PT5 retirement plan screening. But if they are introduced by one of our clients to us, we will actually waive that initial planning fee because they were introduced by one of you. So you can effectively be a superhero, help somebody out who's maybe struggling right now with trying to answer some financial related questions, and have them walk through our process, and it's going to save them a bundle. So anyway, we hope you found value in the class today, and we look forward to seeing you next time. Don't forget to retire with purpose
and retire on time.
Thanks for joining.
Take care.
You've been listening to the 15-Minute Financial Feast podcast. Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time.